Hello, accounting students. This is Mrs. Bloomquist. Welcome back. We are up to lesson 3 now in our chapter 3. Remember, chapter 3 is all about journalizing transactions, and our lesson objectives for this particular lesson would be to analyze and record transactions that affect owner's equity, and then also to analyze and record sales and the receipt of cash on account. So one of the things you want to just be thinking about is that the activities in this lesson really are just more transactions, and that they're going to follow the exact same process of journalizing that we've done in the previous lessons in this chapter. We're just moving on now and looking at those transactions that impact owner's equity. So the first one we're going to be looking at is cash received from sales. And again, we want to be thinking about what are the accounts that are going to be impacted by this transaction because we are looking at the accounting that is double entry accounting. We always have two accounts that are impacted, and we always have a debit and a credit. So the first account we know is going to be cash, and our cash is going to be increasing, which means we have a debit. And then our sales are also increasing. So sales are increasing, which would mean we would be crediting sales. So when we look at this general journal entry, we can see that we're going to note the date, which is the 10th. We're going to go ahead and write the title of the account that's going to be debited first, which is going to be cash, the amount of the debit, which is $1,100. On the next line, we're going to indent. The indent happens automatically when you're working in Applia after you enter in your credits. The reason that you would indent if you were working on a paper journal is so that you could really easily see where your debits are and where your credits are. Otherwise, you don't really have a good visual prompt to indicate one or the other. Again, you want to make sure that you're noting your source document, which would be our calculator tape 10. This is our source document right here. And just as a refresher, source documents are the items that we use to prove that the transactions took place. So source documents are really critical to the accounting process. All right, so the next transaction, we sold services on account. So on January 12th, we sold services on account to Main Street Services for $500, and we issued a sales invoice, and it's number 1. Remember that when we have transactions that happen on account, no cash is changing hands. We sold the services, so in the future, we're going to be receiving payment for those services. I see that my accounts receivable are increasing because of this transaction. I'm going to debit accounts receivable. My sales are increasing because of this transaction, so I'm going to go ahead and credit sales. When I look at this in my general journal, you can see again, I'm going to indicate the date that it happened, which is the 12th. I'm going to indicate its accounts receivable for Main Street Services. Again, sales is the credit. And I'm going to go ahead and write that source document number in the document line. So S1 for the document number. All right, I paid cash for an expense. So I have a cell phone bill, it looks like, a cell phone and internet, and I'm going to pay out cash for that expense. So my communications expense is increasing. That's my debit increase on the communications. Now remember that that communications expense is impacting owner's equity. My cash then is decreasing, which is why it is the credit to cash. So as I look at my general journal entry here, I can see on January 12th, I am noting that I'm going to debit communication expense, and I'm going to credit my cash. My source document, again, is really important. I'm saying C4, which means check number 4 was issued to pay this. All right, I paid cash for an expense. Equipment rental for check number 5. So right below there, again, my equipment rental expense increased, my cash decreased. So on the 15th, I'm going to go ahead and debit the equipment rental expense, and then I'm going to go ahead and decrease my cash. Again, as we remember what's happening here, My expense account is increasing, but the expense account increasing results in a reduction in my owner's equity, which is why it's on the debit side for the increase to the rental expense account. Again, source documents are important. They are what we use to prove transactions actually took place. So C5 then is our source document. All right, we received cash on account. Remember that sale we did to Main Street Services? Now they're paying us some of the money they owe us. Looks like $200. So our cash is increasing by $200. And the accounts receivable for our friends at Main Street Services, that's actually decreasing. Accounts receivable, remember, is an asset, so this would make sense to us why one asset is increasing, the other is decreasing. And if I go ahead and put in my January 16th date, I'm going to go ahead and debit cash. I'm going to credit accounts receivable. And then again, my source document, my R2, my receipt number 2. Paid cash to the owner as a withdrawal of equity. So again, our owner is taking some money out of the business. We're going to $350 is how much we're going to go ahead and journal. So Michael Delgado, the drawing account for Michael Delgado is going to increase. Our cash is decreasing. Remember, the drawing account is one of those accounts that we consider its impact to owner's equity separate than just a notation in owner's equity. So the drawing account is a debit increase, even though owner's equity, the traditional account in owner's equity, would be a debit decrease. Okay, so when we go ahead and journal this, we can see it happen on the 16th. The drawing account is what we're going to debit. The cash is what we're going to credit. And check number 6 was issued for this money, so that's our source document. All right, so when cash is received from sales, which account is listed on the first line of the entry? Well, we would want to be thinking about the 2 accounts that were impacted and which one is going to be the debit. The debit is always first, so cash is our debit. When cash is received from sales, which is listed second then for our entry, and the second then is going to be our credit. We're going to credit sales. When you sell services on account, which entry is listed on the second line? So again, which entry is going to be our credit? That's sales. When cash is paid for any reason, what abbreviation is used for the source document? So when we pay out cash, it's always C for a check, our check number that we're indicating the money was paid out. When cash is received on account, what abbreviation is used for the source document? So if we receive money into our business, how do we note that? We go ahead and issue a receipt for that cash or a check. They are considered the same, so we would use R for receipt. Okay, so that would be the end of the lesson. From here, what you really want to be thinking about would be the risk associated to a business of not recording a sole proprietor's withdrawal. So what would happen to the business records and the accounting equation if withdrawals were not accurately reported? The other thing you probably should start thinking about in terms of the business would be how long you think it's reasonable for customers to go ahead and pay their services that they've purchased on account. And is it reasonable to give them a long window of time, like 60 days, or should a shorter window of time be issued, say 15 days, and what we might think would be a reasonable amount of time to expect our customers to pay us? All right, from here, go ahead, do the Quizlet, the quiz that's out on Google, and then you can go ahead and do the work together and on your own. Good luck.